Well, it's indicative of what we do, in terms
Yeah.
of this. But can you see my screen?
I can. We can all
Does it
see. I certainly can. I'm confident everyone else can
does
too.
it say combination strategies?
It does, and it has the
Okay.
chess pieces.
Okay. I'm just not so with GoToMeeting. I just want to make sure that I've got it before I dive into it here. So let me see if I can remove a few things off my other screen and make sure that this is going to move forward.
Folks,
Okay, all right. There we go.
thank you. Go ahead,
Go
Tony.
ahead. Oh, I was just going to
No, I
say,
just wanted to mention everybody, you got to let us know if there's a sound issue or there's a visual issue. Otherwise, we're going to assume everyone can see and hear everything clearly.
I will try to speak up. I have my headset microphone on full whack right now, so I'll
Okay.
try to be as clear as possible. Okay, well, anyway, yeah, what I wanted to present here was one of the ways that I trade. Now, I've been trading for a lot of years. I'm a full-time trader, a retail trader. I'm not a floor broker. I haven't, done any of that stuff. I basically trade, from a desk wherever I happen to be, at my house, at my office, or on vacation, or whatever. Um, Now, one of the things that I've developed over the years is a way to sort of manage positions totally by analyzing just the Greeks of a position, and I like to call that combination strategy. So what we do is we actually mix together some different tactics. Um, First of all, maybe I should say the difference between a tactic and a strategy. Like a strategy is that we want to benefit from time decay of options, and we think that the price may stay within a certain range within a certain period of time. That is a strategy. A tactic is a like a butterfly, a condor, a calendar. So that's kind of the terminology that I'll be using. So what I do is combine tactics within a strategy.
Very interesting.
You wanted me to present the disclaimers, which I think you read.
Yes.
So there's that number one disclaimer,
Yeah.
and here is number two disclaimer. Now, um, I am going to show you in this presentation. You're going to see one of my actual live trades that I do or am doing currently inside of our options trading room. Now, those are my trades with my fills. And they are, they're not any sort of back testing. They're done, live as the day progresses every day. But you will see a hypothetical butterfly that we're going to compare, which I did not trade, but we're going to use the option view mid prices, which are pretty accurate most of the time. So it's a good representation. Okay, so today we're just going to look at everybody likes butterflies. They got a great risk reward profile most of the time if they're put together correctly. So a lot of people employ those, and we want to look at a butterfly tactic versus a combination strategy. Now, what I did was I didn't go back and back test the butterfly and optimize it or anything like that. What I did was I took an actual trade that we began in the NASDAQ using our combination strategy on, we started it on November the 27th. So I said to myself, well, why don't I just go back to November 27th and do an at the money butterfly just the way I normally would do it if I was going to do a singular butterfly strategy. And so that's what I did. And you'll see that it's interesting how it works out. What you see on the screen right here is on the top left is the actual butterfly in the NASDAQ that we're going to be looking at in this presentation. That's a graph of it. Obviously, to the right of that is a condor. Everybody's familiar with that. Bottom left, you have a condor with the butterfly overlaid on top of it. And then to the bottom right, you have several lines. You've got a blue, a green, and a red. And you see that you have the condor, you have the butterfly, and then you have a split strike butterfly, which is the green. Okay, so you're going to see a little bit of each one of these tactics within what we're going to do today. One thing to point out about wing spreads, a butterfly is nothing more than an at the money condor. So
Right.
they're all very, very similar,
Yes.
especially when they start out. So it's just a matter of split strikes. Your short strikes just get further and further away from the money, and that's known as a condor. Um, the closer they get to the money, it starts to become what's known as a butterfly. Okay, so
Right.
let's go take a look and see
Yeah,
what
really,
we
so you can call a split strike butterfly an iron condor. It is in fact an iron condor. It's just the wings are
closer to.
farther out than you would typically expect them to be.
Yeah, I mean,
Right.
if you start, a condor is nothing but a spread out butterfly. I mean, a butterfly has its short strikes. Well, let's just talk about it at the money. The shorts are at one spot, one strike. Then you go to split strike butterfly. You move them the short strikes separate strikes away from the
Yes.
money, and then a condor further and further and so forth. So
Hmm.
there's several. That's how the progression of it. Okay, so um, here's what we did. So on November the 27th. Now I picked this date because that just happens to be the date where I started my real position.
Hmm.
And we're going to compare this to the real position. So what I just said was I'm going to do a at the money butterfly, and I'm going to use about the same amount of margin that I'm using in my other position to
Hmm.
compare it apples to apples. And I'm going to do it the way that I would normally do a simple singular strategy or tactic, and that's going to be at the money. And
Right.
in the Nasdaq, it's going to be with 75-point wings. So here's what it looks like on the graph, and most people are familiar with on the matrix. Most people are familiar with how this looks. This where you see these numbers, long 20, short 20. That's the existing position. Here's my original prices, and in this trade column over here to the right of that, that's where you're going to see where I put my adjustments.
Okay.
I think it's pretty self-explanatory for most
Hmm.
people as we go along. Okay, so there we are on 11 a.m. That's where we got started on November the 27th. Okay, this is 2 days later.
Right.
The market basically had gyrated up and down a little bit,
Hmm.
and now at 10:30 a.m., I think it's time to look at an adjustment. Here we are. If you see this little black dot, that's where the current price is,
Hmm.
and we're starting to sort of get closer to the edge of this butterfly. One of the ways now there's let me just make a statement. Obviously, people who've traded butterflies know that there are many different ways to trade it. Um,
Hmm.
so this is not a butterfly class. I'm just going to show you the way that I would trade it as a singular position of what I would do compared to the combination tactics. So
I understand.
when the market starts moving to this direction, say halfway between the middle area and break even, I start
Right.
to think about what am I going to do? What's my move? Do I need to do anything? So yeah, I'm starting to think about an adjustment right here, and this is
Hmm.
2 days into the trade.
Right.
Um, Here we are. Here's the at 11 o'clock. If you look down here at the bottom, you'll see that we're down about $6,900 on this trade after 2 days.
Hmm.
And these are our Greeks. The existing trade shows that we're basically short 200 deltas, 199. We have theta of 697, and our vega is short, 3 times that. So,
Hmm.
it could get away from us. The market's up 20. It could go a lot higher during the day. So, most butterfly traders, including myself, would opt to maybe add to the position right here. So that's what I decided to do was just do something that I would normally do, and that
Hmm.
is that I'm going to lay on another butterfly, you know, to 2 strikes up in the calls and the puts. So this is my adjustment,
Hmm.
and you're going to see in a minute that those get converted. They add into our existing position. So the graph of the butterfly with the adjustment would look like this.
Right.
Okay, not the greatest thing in the world, but still, it's only 2 days into it. Okay, so let's move on. Now, nothing happened between, let me go back to that date. Hold on just, okay, November the 29th was when we made that adjustment. Nothing happened really in the market between there and December the 5th. The market was kind of up and down a little bit, and the position was mildly profitable and then mildly not profitable. So it was pretty much treading water for a few days. now what's happening is the market's starting to sell off a bit. So now we're at the other end of the put side of our butterfly. So now we're getting down to this area. So I think it's time to start thinking about what are we going to do if the market keeps going. This is on December the 5th. So this will be our second adjustment. All right. Now remember, our existing position right here in the butterfly had our original position plus the additional butterfly that we added. So that's what you see, all these 20s. So look, what would I do? Well, should we cut and run on the previous addition that we made to the trade? I think so. That's what I would do. So what I'm going to do is, even though I added another butterfly higher up, as they say, another butter further. That's my attempt at humor. Well, anyway, what I'm going to do is I'm going to go ahead and get rid of that. So this is what I'm going to do. I'm going to buy back these. Oops. I'm going to buy back these 20. Sell those. Same thing, buy those, sell those. So I'm going to be back to our original position. Hang on. Now I've got to click on it, make sure it's active so I can go forward. Okay.
So you're just closing the upward adjustment is what you're doing.
Right. Yeah.
You're just closing that initial butterfly. You're back to a single butterfly centered where it was originally.
Yes.
Correct?
I did was close the additional butterfly, the first adjustment.
Right.
It looked like the market was going higher. Now it looks like it's going lower. So I said, well, I'm just going to get rid of that. I'm back to where I started. So now I'm back to the original position, and it looks like that. And you can see I'm still treading water, after a week or so.
Mm-hmm.
Okay, so I've made 2 adjustments for a total of 180 contracts
mm-hmm.
in the NASDAQ.
Okay.
All right, let me click on this. For some reason, it doesn't advance the first time I hit the key. Okay. Hang on just a second. There's a little bit of a delay in this advance. Just want to make sure I don't miss anything. Okay. Well, now look what happened. Okay. Now on December the 11th, now this is probably fresh in your mind because it was just yesterday. What happened between the 5th and the 11th, and why didn't I show anything? Well, nothing happened. It went up, it went down, back and forth. We were up about maybe $6,000 on this trade at one point, the high water mark, back and forth. And then yesterday, we started to have a big move up. Now, here's where we are, the black dot at 10:30.
Right.
We had a big move, 40 points. Well, it's not a huge move, but a butterfly by definition has a pretty narrow stance. So here we are again. So now we're going, first thing I'm thinking is, well, I should have left that adjustment on, but of course I couldn't. I should have left that. I shouldn't have made the adjustment, but you have to adjust if you're going to trade as a business. You can't just let it ride. All right. So let's go to the next slide. There we go. All right. So here's our question now. Okay, we're into this. It's December the 11th. We started on the 27th. It's not a huge amount of time, almost 2 weeks. All right, should we go back and add this butterfly that we took off? Another butter further up. This will take us back to the position we had a couple of days ago. Oh, but did I mention there's only 10 days left to expiration? So would we do that? So I don't know. What's an alternative move? Move forward. Why won't this thing advance every time I press the button? Hang on, guys. For some reason, there's... There we go.
Okay.
Sorry about that. Okay, if we added another butterfly, it looked like that. All right, well, that's not bad. I mean, over the next couple of days, we could really see some significant profits come our way, but still it's pretty narrow. So and we'd have to, add on, do another 80 lots, total in the NASDAQ. That's one thing we could do. All right. Some butterfly traders would roll up the entire spread instead of adding another butter further. Now, this may look like a lot of stuff here, but in essence what it is we're taking out these short 20 by buying them right here. And then we're just moving up one strike. So we're just moving the whole butterfly up one strike. But you see that we got a lot of work ahead of us here. lot of spreads. Okay, so that's what I would do if I was going to stay with the position, another 5 days or whatever.
So in this case, it was not really. This is really a rolling of the butterfly up a strike. Correct.
Right.
Right.
That's what this was. Instead of you were not adding to the position, but just sort of rolling it up.
Mm-hmm.
Now, if I can get that to advance. Okay, now this shows the difference between those two strategies. Now, this is not a butterfly class, so I'm not going to get involved in discussing which one of these was the better move. Okay, I'm just going to show you what I would have done, and I would have done the red one. Whoops, I keep clicking on that; it turns blue. I would have rolled up the butterfly instead of adding to it, especially with 10 days to expiration. The red line.
And why are you drawing a distinction between 10 days before expiration and
just
earlier
because,
than that?
Well, because what's going to happen is if the market does stay within our range and behaves, our gamma is going to increase to such a large degree that it's going to be very, very difficult to manage the deltas.
Mm-hmm.
In other words, manage the position.
Right.
The further you work your way up this profit zone, the more steep the curve becomes, and therefore you're susceptible to, any, move one way or the other. A sustained move could bring you right back to zero. It's difficult to manage as you get closer to expiration. Okay, so that's the two different graphs, and of course I would have done the red one. Okay, so this here's where we are today. So I made that adjustment inside the butterfly. So at 10:30 today, this is where we were. Okay, we're back to this position. We're up about $3,000. You'll notice our delta is minus 420.
Right.
And our theta is 2,000, and our vega is about 1-to-1 with theta. Now, we've got a problem with this position. I don't know if you guys can see it readily, but I just pointed it out. Look at our delta. I mean, it's way short. So really, it was time to make another adjustment on this trade. So how many adjustments was that? Let's see, 1, 2, 3, 4. 4 adjustments with an average of 80 to 80 lots every time.
Right.
Talk about slippage. That's a lot of movement. That's a lot of adjusting.
Yes.
Okay, no matter what underlying you're trading. So, but hey, look, it's making money, right? So, it's not a bad position by any stretch. Here's what the graph looked like this morning at 10:30. So we're back up here to the, rubbing the top side of this after a big move up yesterday. So that's the butterfly. And I was getting dizzy doing all these adjustments. Okay, so now again, it's not a butterfly class, so I'm not going to go into why wouldn't you have done this or that or whatever. This is just straight up one singular strategy, making the minimum amount of adjustments and so forth. Okay, so there it was. Now you see we had to do a lot of work on it. All right, now what about a combination strategy? Okay, over the same time period. Now, I didn't go back and optimize this. I didn't, stack the deck and say, well, my combination strategy is going to smoke the butterfly, blah, blah, blah. I just started them on my most recent campaign that I've been doing live, and that's it. That's all there is to it. If you guys will let me, I've had a cold for the last 3 days. I need to take a sip of water. Give me 1 second.
All right. Of course.
Just a second. Okay, sorry about that. Okay, so now let's go see about the, the question is, well, G-Tone, what did you do?
Right.
All right, well, here's what I did. Okay, so November 27th, and this is at 4 o'clock because, it's put this on, throughout the day. First day of the trade right here. Everything is in the puts. Now, this is a combo, and basically you'll see that it's a credit spread, 20-lot credit spread, and a 5-lot debit spread.
So
right here.
Somewhat broken wingish. Yeah.
Yeah, I mean, it's, obviously the credit spread is neutral to bullish, and
Right.
the debit spread is also known as a bear spread, which means that you're not so neutral but more bearish. So
Mm-hmm.
I mixed them together, and the reason I mixed them together is because I want to control my Greeks. So my delta is 20, my theta is 260, and my vega is a little bit short, but starting out that tends to happen. So it's 3 to 1, but my most important, my delta theta ratio is 10%. And
Now,
that's
Tony,
how
will you generally start your positions out as this combination put side credit spread with the smaller bearish debit spread, or is that going to depend on the month and your read of the market and so forth?
it depends on the month, the read of the market, and volatility. In fact, this is the first campaign in the last 6 months that I've actually had a separate debit spread, like these
Mm-hmm.
5 lots here. Generally, what I've been doing is a ratio spread. So I'd be, say, long 5, and then down in here somewhere short, 25 or 30, and
Mm-hmm.
then pick up the difference, way down here. But this time I did it a little bit different because mainly because volatility has been well within, well at the lows of the
Mm-hmm.
last 3 years for a while, and I just don't think it can stay there, especially coming into the end of the year.
Mm-hmm.
So that I decided to start this way this time.
Can we take, do you have a graphic look at that in one of your
Yeah,
slides?
yeah,
Yeah,
it's coming
good.
up right there.
Great.
All right, that's what the graph looked like to start with.
Mm-hmm. Mm-hmm.
Now I know, you guys are sitting there going, well, yeah, wow, what's that? Well, okay, here's what it is. It's 4 o'clock the same day, right? What it is that at this particular moment in time, I thought that the market had the potential to go higher before it went lower. Okay,
Mm-hmm.
so what I wanted to do was wait till the market went higher before I sold some credit spreads. I didn't want to sell them this day and then, have them double on me. I wanted to wait and see if I could get them at a better price. And if nothing happened, this little dotted line right here is basically 12 days later.
Mm-hmm.
So if nothing happened, I'm fine anyway.
Right.
Okay, so I'm, unlimited to the upside. It doesn't matter. Downside, I'm covered pretty well. So that's how we started day one. All right, fast forward a couple of days. November 30th. Now, what you're going to notice in this particular trade is that I'm going to make some what we call adjustments, but really these are not adjustments because of delta issues or the movement of the underlying. I'm in the building mode. Okay, so what I'm doing
Right.
is I'm trying to build this position.
Mm-hmm.
So I realized on the 30th, I realized that I was a little bit, I had one too many of the debit spreads. So I just wanted to correct that and get a little bit more theta coming my way because the market had stayed right around there. So I'm going to, sell one of those and buy one of those. And I did that. And now it looks like this. So you see now that my expiration line has gone up, to a couple $1,000 instead of right at zero. So what I'm
Right.
doing is the market's sticking here. I'm just trying to lift it up. Okay, just get
Mm-hmm.
more theta coming my way. All right.
So you had intended all along to build the call side credit spreads over time in the trade, but you wanted to wait for what you thought was going to be a rally. Is that a fair statement?
Yes.
Okay. Mm-hmm.
Yeah, and then I did that. Hang
Right.
on just 1 second here. I think I forgot to add a slide. Yeah, when I actually added this, okay. I should have had another slide here. I just noticed that. The what I did was I added as the market did rally. Okay, between the 30th and the 4th, I did add this 5 lot credit spread right here,
Mm-hmm.
and I only put 5 in there because I anticipated it going higher, but it didn't right away. So I was
Right.
stranded with 5. All right, so I made that adjustment, and then on December the 4th, this was the next adjustment, and this is still building. Okay, so I added 5 put credit spreads for more theta right down here.
Right.
Puts. So I'm going to add those over, and then I threw in a calendar. Okay, so now what have I got? I've got basically a condor, a lopsided condor, got this credit spread and this credit spread. I got a debit spread and I've got a calendar, right? All right, well, if you look at the Greeks down here, why did I do that? Well, I'm taking my Vega for the main reason was to take the Vega and theta ratio down to 1 to 1. You
Right.
see on both right here, that's including the adjustment.
Mm-hmm.
It also took gamma, well, gamma stays at 1. And it took my theta up by $150. So that was, the main reason was to get more theta and
Right.
try to neutralize Vega so it doesn't become a thief in the night on my trade somehow. Okay,
Yes.
so here's what that looks like after that adjustment.
Why didn't you, was there a particular reason you didn't try to control Vega earlier in the trade?
It didn't really matter that much earlier in the trade because I was still in the building mode. So
I see.
if the market would have gone down and
Right.
Vega would have gone up, I would have been happy to see that.
I see.
Because then I could lay on more put credit spreads and call credit spreads and try to benefit from that.
Okay.
But I wanted the market to go down into the big profit zone down here.
Mm-hmm.
But alas, the market was not cooperating. It's hanging around. So I said, well, I got to start trying to get more profit where the market's at as time goes on. So that's the move I made. And this is what the graph looks like.
Okay.
Okay, quite a bit different than the butterfly. All right, now on December the 5th, that was the next move. But I'm still in the building mode. Okay, I haven't made any adjustments because of price movement. None.
Okay.
Okay. Well, except for when the market did rally, I added the credit spread, but it was not an adjustment. It was an addition to the trade. It wasn't a defensive move.
Mm-hmm.
All right, so now here's what I want to do. The market's down 24. It's 11 o'clock. What I'm going to do is I'm going to roll this credit spread down, and I'm going to increase the size of it. So I'm going to sell 10 of these calls. I'm going to buy 15 of these. That's going to cover 5 of those and leave me long 5. And I'm going to sell out these 5, these stragglers. So I'm going to be left with short 10 and long 10 and the rest of the position. And you'll notice I continue to add to my theta. It was 533, now it's 750. And the Greeks are still pretty good, except that I'm getting a little bit shorter Vega. But that's okay because the market was down and Vega was up a little bit that day. All right, so now this is what the position looks like. Very similar to what it was, but you'll notice one thing, it just keeps getting taller and taller in the center.
Right.
More and more potential profit.
Tony, we got an interesting question coming in here from John Dory, which is, do you begin your positions with a plan for how much capital you will ideally employ, or are you just adding positions based on the Greeks regardless of capital level?
No. What I do is this particular account with this particular trade has a maximum capitalization of 125,000.
Okay.
So all of my trades, I have a maximum allotment that I use. Now, sometimes I'll only use half of that because I never get the opportunity to add to it.
Right.
But most of the time, though, I will push it, to about 90% of the capital.
Mm-hmm.
But no, it's not just unlimited. So some of the moves that I make have to do with controlling margin as well.
Mm-hmm.
That's kind of a separate topic, but believe me, it's involved in this.
Okay.
As well. Okay, so that's what that looks like, on December the 5th.
Mm-hmm.
All right. Here we go. Yesterday. All right. It's 11 o'clock. The market's up 40 on NDX. Now it's time to consider an adjustment due to price movement.
I see. Right.
Okay, so what do? Well, I look down here first at the easiest adjustment possible. I look at this put credit spread. It's trading at 130 on the shorts and 80 on the longs. It's 50 cents. Not worth keeping, so I roll it up.
Right. And you had originally taken in a credit of more than $3 for that, 3 1/4.
Right.
It's down to 50 cents now. So you can kind of kill 2 birds with 1 stone here, right? Cut your deltas and bring in more time premium.
Well, look at the margin over here to the left at the bottom.
Yep.
you'll see
Right.
that my right the existing is 104,000, and look, my new move is 103. So
Right.
what do? I don't increase my margin. I correct some of my Greeks. I gain more theta, and I cut my deltas down. So basically, I sold 25. I bought 50. And the reason
Mm-hmm.
I bought 50 is because 25 of those cover that one, so it
Right.
leaves me long 25, and then I sell out these last for whatever I could get.
Yeah, you were
Uh,
actually technically selling a butterfly,
yeah,
selling a put side butterfly. If you look at the transaction.
right. It's the opposite of buying a butterfly. Yeah.
Right.
But the way that I did it was I did it in two increments. Actually, what I did was I bought the credit spread here.
Mm-hmm.
So I
Mm-hmm.
bought 25 and sold 25, and then I sold 25 and bought 25.
Was that
So
because you were timing the market, or why
no,
do you do it
no,
that way?
I just less slippage. I just don't
I
want to
see.
do a butterfly. I don't want to sit there for an hour trying to get filled on a butterfly
I see.
when I can bang out two credit spreads. This
How's your
debit spread.
execution in NDX? Are you able to get
Uh,
around mid most of the time, or what's your
yeah,
observation?
around mids, but you can see that this particular day the volume was thin. That
Yeah.
that kind of it depends. But yeah, around mid, 10 cents less than mid sometimes.
Right.
If you're patient, you can get right around mid. So it's not too bad. But again, and I'm going to get to this, but I don't like to. I like to structure my trades where I don't have to use a lot of contracts to
Right.
get the same desired effect. Um, Compare it to the butterfly. We were trading what 80 at a clip. Okay, this is
Mm-hmm.
my first real adjustment right here at a 25 lot. So I've suffered a lot less slippage on this than the other one. All right, so here's what the graph looked like before the adjustment. So you see
Mm-hmm.
that we're like, yeah, I'm going, yeah, I've got room to hang around, but man, I don't want to go back to zero.
Right.
Okay, so that's the adjustment. Okay, at 4 o'clock, this is
Mm-hmm.
what it looked like after the adjustment, and you can see I'm up 3,500. And where were we on the butterfly? We were up about 4, right?
Mm-hmm. Mm-hmm.
Okay, so overall, after all this, the positions were kind of similar in terms of their outcome dollar wise, but they were extremely different in terms of the amount of adjustments and why you adjusted and the angst or anguish you went through. Okay,
Sure.
but it's not over with yet because this is what it looked like yesterday.
Mm-hmm.
All right, here's today at 11 o'clock. Did I have 2 slides? I had a slide of that earlier, didn't I? Yeah, so
Mm-hmm.
we're here.
Right.
Greeks are in great shape. There's nothing really to do. It looks like that.
Tony, we've got a question that's come in. It's interesting. Rob Fittler's asking. Um, I think what he's trying to say is when you're putting the the credit spreads on, when you're adding credit spreads, is there a particular delta of the short that you are looking at? How do you decide where to put that credit spread? I guess is another way of asking the question.
Um, well, it depends on the rest of my position. I mean, typically when I do a credit spread, I like to view it like if I was going to do a condor, what would be my short strike? The delta. Would it be 10, 12, 15? In that
Right.
range. What I want to do on a credit spread is I want my shorts to be well away from where the market is, and I don't want there to be really any reasonable expectation that we're going to get down there.
Right.
So in conjunction with the rest of the position, that's kind of how I place those.
I
And
understand.
also, this is a portfolio margin account, so I have to consider margin requirements as well.
Mm-hmm.
So it can't get too close to the money because starts costing more in margin.
Tony, is part of the answer. I'm not trying to put words in your mouth, but sort of knowing the way you trade, it strikes me is part of the answer that you you have a certain Greek goal in mind, and so you'll be as far away from the money as you can, but you need to be able to achieve your Greek's goal at the same time.
Well, that's pretty much exactly it, because
Right.
combination strategies is all about managing by the Greeks, not by the deltas. Okay, not by you
The
know
deltas of any particular strike, in other words.
yeah, or any
It's
particular.
the total position.
Yeah, like for
Right.
instance, if I go back and you look at this, okay, I could isolate every bit of this trade. I could isolate these short 25 credit spreads against the short 10s. So I could
Right.
make that a condor and look at it separate. I could look at the calendar separate and the debit spread separate. But I don't want to do that. What I want to do is I want to look at the overall Greeks, because
Mm-hmm.
that's what I'm interested in. I'm not
Right.
interested in, well, the market's moved, 3/4 to the goal line, or it's halfway to, expiration point, or delta's gone up to 30 on the short strike. I don't want to do that in combos. In
Right.
individual strategies, that's how we have to do it. Okay,
Mm-hmm.
but this gives another layer of flexibility, in my humble opinion. So it
Mm-hmm.
looks like that, that's how we wound up, towards the end there. So
So,
let's go so let me close this for a second. Okay. Just give me 1 second. Let me switch programs. Okay.
okay.
Let me go to live data. Um, hang on a minute. Now, why won't that go over there? Oh, I see. Why. Got to move the whole program. Tone, come on. Okay, so let's get out of the rut. Let's go to the NASDAQ. Okay, I want to show you guys. Okay, this was the test account that I did the butterfly in. Okay, here we are, right here. Here's a transaction log with all the trades.
Right.
Okay. So here's where we are today after today's down move, right? Look, it's up $9,400. So, pretty good, but I want to continue to show the comparison here between
Mm-hmm.
singular strategy and combo.
Mm-hmm.
Now, this to me, I think that all of us that have traded for any length of time would look at this and go, yeah, we're up a decent amount of money, but I'm not going to sleep very good tonight.
Correct. Right.
And why is that? Because you could easily be at zero tomorrow.
Mm-hmm.
So you wouldn't have left this like this today. Okay? Because earlier today, the NASDAQ was up 10.
Mm-hmm.
Okay, so you wouldn't have left it. I didn't make any adjustments to it because, my comparison was kind of over. So you would have had to have done something to this trade because you were down 500 and something deltas earlier. So the point is that with the singular strategy like this, and actually this trade could have done a lot worse. The reason why it did pretty good is because volatility was low and stayed low throughout the whole trade. Vol never really went up 3 points or 4 points and stayed there.
No, that would have been devastating to the P&L.
Yeah, you'd been underwater the entire time.
Right.
This trade actually was underwater by $6,800, like within the first 2 days.
Mm-hmm.
And most people would say, wow, they might panic. They may say, I have the wrong tactic, do something different. In other words, we don't want to be in that position. That's all I'm getting at. Okay, so let's go look at okay, this is my actual portfolio margin account for our options trading room, and this is that position. Let me move it over just a little bit in the center. Okay. Okay, yeah, okay, look, I'm up 4,700. The other trade's up more, right?
Right.
Well, which trade is better? Well, look at my Greeks. Okay, my delta's 30 minus 38. My theta is 971. So what? Theta is way less than 10%, right? Of theta.
Right.
Vega is being put out of the equation. So in other words, I'm isolating Vega. Not isolating it. What I'm doing is I'm neutralizing it. I'm isolating theta. Look at gamma.
Mm-hmm.
Okay, gamma on the singular butterfly over the next day, 2, 3, it's going to get extremely wild. And that means that, for every point up, Delta's going to change maybe, 30 to 50%. Who knows? I mean, it's just going to get crazy. But
Right.
here's what this graph looks like. All right. So, do I have a problem holding on to this thing for the next 5 days? No. I mean, to me,
Right.
it's a much better position because it's trading more like a business and less like a gunslinger.
Mm-hmm. So you'll go to sleep. You'll go to sleep at night knowing that even if there is a rally in the morning, your profits are still going to be there. In fact, you're still negative vega, right?
Yeah.
So you'll have theta and vega both working
Vega.
for you if there's a rally.
Mm-hmm. Yeah, and plus you notice that I've got that little calendar right here. So you notice what happens, it lifts it up. So it gives me some added protection over the next couple of days. But
Yes.
obviously I'm not going to leave it. I've got one more move to make on this thing, and that is I'm going to lift this area up if the market doesn't head down that way. So I'm going to pull that up into this area and keep it basically for the next 5 days. I'm not going to expiration, but
right.
See, what I like to do is I like to pick a zone that I think the market could go to down below the market,
Mm-hmm.
and give myself the opportunity to find myself towards expiration down in here. And that happened in the rut last month.
Mm-hmm.
We closed out like right in here, like a couple of days before expiration. But okay, so the point is that the other, I can't overlay the butterfly, but the point is that with combinations, you have more alternatives as to what you can do to control the position.
Tony, I'm curious, how do you effectuate that, elimination of the lower profit level? Do you buy back, you start to sell off that debit spread?
Right here. These two, here's the way that I adjust these trades coming into, this close to expiration. The only two operable things are the calendar and the debit spread.
Right.
Okay, the credit spreads do not move any further.
Okay.
They stay there no matter what. So here's what I would do. I'd get rid of the calendar.
Mm-hmm.
Now, I'm not saying I'd do it all at, it's only 2 contracts. Okay.
Right.
Okay. So now that's what it looked like. The blue was with the calendars, the red's without.
Right.
Now, what happens? Yeah, okay. Well, hey, you gave up this little thing right here. Well, you know what? I'm not, even if the market was right here the day before expiration, it's not going to be anywhere close to that profit because they're going to make me sweat it out into settlement value Friday morning, right?
Right.
It's just not going to happen. So I don't trade for that, but I just give myself a little bit more room to lift it up here. And then, the next move beyond that ultimately would be to start whacking off, start closing out.
You did too there, Tony. I think you meant to. I think you meant to close. Yeah.
I did.
Yeah. There you go. Right.
Well,
so you'll sell a credit spread to start to close that debit spread out, right?
Yeah. I started laughing at myself for what I almost said. Okay, so it starts looking like that. Now, what does that look like? Condor.
It's starting to look like a condor.
Now, I want to ask you guys, all of you guys that have traded for any length of time, would you rather have a condor towards the end of expiration or towards the beginning? I want to wind up with the condor type position,
right?
Because it's wide, it's flat, and it just gives me smooth sailing. Not at the beginning, because at the beginning, you know what happens. You find yourself underwater quickly. So that's when I move towards the condors.
The condo, yeah.
move to my condo. Yeah. So that's it. And it's not. Notice how also I consolidate my strikes. I don't like to step over them.
Right.
So
what percentage of the time, Tony, would you say your trades have this general appearance, where you start out with the put side credit spread protected by the debit spread, and then you start to sell your call side, and would you say most months of the year it starts to develop like this, or is there just no rules at all?
Um,
I'm
well,
sure every
this
trade
look,
doesn't look exactly like this, but do they sort of generally evolve like this?
yes.
Or mm-hmm.
When we, and I'm not volatility environment.
Mm-hmm.
Okay, I'm not going to really have this big Hawking ratio in the puts because
Right.
I'm going to know that, and I do this in the Russell too, not just the Nasdaq. But I know that the market can make a sustained move.
Right.
So it's sort of when the market is behaving and vol is low and it's kind of staying low, and you have things like you know election cycles, and it's like the last 4 months, been pretty much, we kind of knew what was going to happen.
Right.
So, but next year's a different ball game, so I don't know
Mm-hmm.
what's going to happen. So
Right.
I might change, but overall, overall, most of my positions have a structure that looks like this.
Mm-hmm.
But here's where I like to be. I don't really love to be in this area up here.
Right.
Typically, I want to be right inside of that line
Right.
down here. And the reason is because I know that if the market goes up, as long as I don't have too many calendars to have this potential line go lower on
Right.
a volatility drop, I'm positioned to benefit down in here,
Mm-hmm.
and I'm also okay to the upside. So that's where I like to be, but it doesn't happen that way all the time, and that's where we are on the Nasdaq. So
This reminds me a little bit of the broken wing butterfly in that, it's sort of like you have a credit that you're shooting for in normal months, but you get this lottery ticket now and then where you end up in that sweet spot of the put side towards expiration, and you can make a lot more, as you alluded to earlier. How many times a year does that tend to happen where you sort of get a timed rate and you end up in that high profit zone on the put side?
twice.
Twice a year? All right, so that gives you a little opportunity for increased return.
Yes, it happened, as coincidence would have it. It happened last month. When I
Mm-hmm.
say last month, I mean our last campaign in the
Right.
Russell in our Reg T account. I happened to get it right, and so we landed right down in there.
Mm-hmm.
Um, and again, but if you don't leave yourself the opportunity to find to have that happen, it won't happen. But again, you can't. You have to be realistic. I mean, you can't have it 400 points below the market and say
Right.
if it lands there twice a year, I can retire. It's got to be within. And there's a reason. Look, there's a reason why, like these colors on this matrix. There's a reason why I put short. Excuse me. I put long puts and things inside of one standard deviation. Yellow
Right.
is one standard deviation from the current price. Green is 2, and white is 3. Um, if I'm going to give myself a good chance of finding the price down in that zone, I need to
Right.
be within one standard deviation somehow,
I see.
because it gives you the possibility. But if you're way, way, way down here, that's why the shorts like this this put credit spread. Look, man, it's a 6 delta. I mean, I want it way down in here. I don't want the market to get close to that.
Right.
But what I do want it to do is I want it to get down to here.
I see. Right. So start to put some value into the debit spread. Yeah.
Right.
Right. It very
So
reminds me a lot of a broken wing butterfly sort of an approach.
it is. It
Yeah.
is. A
Mm-hmm.
broken wing butterfly is a great alternative to a put ratio spread because
Yes.
it's covered,
Yeah.
and you can put it in a Reg T account,
Right.
and you still benefit, from a falling market, even though you may have to suffer through a little bit of inflated volatility. It's okay. Well, generally okay. Um,
So Tony, we've got a couple questions that have come in.
okay.
One from Mike Brannigan. He's asking, have you ever gone further out in time, 2 to 3 months, where you could widen out your strikes and have more time to make adjustments?
No. Well, let me. yeah, I mean, throughout the years, I've looked at all different types of time frames,
Right.
but no, now no. I trade within 30 days. And sometimes it's 31 days or 2 days. Sometimes it's 25 days. Sometimes it's 21. It's not uncommon for me to be out of the market for a week or 10 days, or even 2 weeks sometimes.
Mm-hmm.
If I don't like if I have a skew, between front month and back month that I don't like, or if the
Mm-hmm.
market is just kind of not behaving, like if it keeps fooling me in my mind, like I'm getting ready to set up a position and then, you know, it collapses or rallies and now I've got to move it. In other
Right.
words, I just wait till conditions are correct. But no, you will not see any benefit, Mike, by going out to February and trying this trade. Basically, you're not gonna have well, you're going to have so much volatility risk, and you're going to have so little theta that
Right.
it's just you're going to sit around for months. Uh, you may not have to make any adjustments, but it doesn't.
Well, and you're tying up the capital that whole time, whereas you can keep recycling your capital, right, Tony?
Yeah, yeah.
Yeah.
Now I know that a lot of people are familiar with stacking, condors and things. I think there's several different terms for it, but like you have something in the front month, you have something 50 days out, and they sort of overlap each other.
Mm-hmm.
It's just another, sort of way to trade.
Right.
I like to be in the market for the fewest amount of days possible.
Mm-hmm.
And with that said, the average trade, like you asked me earlier, it's 17 to 20 days, so about
Mm-hmm.
3 weeks,
Right.
overall.
Mm-hmm.
Sometimes more, sometimes less. But that's the time zone I like to trade, or the time frame I like to trade in.
And Tom is Tom Bro. I'm sure he's got the rest of his name, but we'll call him Bro. We'll call him Bro. Does Tony only trade one expiration at a time? Is the question.
Yes.
Right. That seems to be the case. Um, and finally, another gentleman or lady is asking: is that quantity put side credit debit spread ratio? 6 times. Is that standard, or was that something you just selected for this particular expiration?
It's just something that I selected for this particular expiration.
Uh-huh.
These ratios can change,
Right.
okay, depending on, well, in this case, I have a debit spread in front of a credit spread.
Right.
Sometimes what I'll have is I won't have a true debit spread. I'll have a ratio spread. So I might be, say, long 10 and then come down here. Well, it's so close to expiration, it wouldn't be where I would do it, but then short 30.
Right.
And then maybe way down in here, long that other 10.
Got the other 20, something
Okay.
like that.
Yeah,
Okay.
but it doesn't. The way that I go about designing these trades, and a lot of people, it's hard to explain because I know that some people are used to, like, hard and fast guidelines. Start
Right.
on this date of expiration, start with these strikes and so forth. I don't. What I do is I take my general idea of where I think the market may be able to go up and down, and I say I
Right.
want to cover that range. And then I say, where's volatility? Is it low, medium, high? Where is it? And then I decide on, which I usually start in the puts. And I say, okay, how do I make money and protect myself at the same time? And it changes. And so
So,
it's not uncommon for me to spend, 2 days
mm-hmm.
sometimes, like trying to decide on a position. Not
Right.
that everybody needs to do that, of course.
Right.
I'm not saying that option trading requires that. But for me, I don't like to move my big contracts
Mm-hmm.
up and down a lot. I like to try to pick a spot and keep them
I see. And
without having to do a lot of movement.
then use your other adjustments and so forth to control the risk.
Right, using
I got you.
these inside, yeah. So the outside credit spreads with the inside calendar or
Right.
the debit spread. Now you'll notice that a lot of people say, "Well, Tony, well, it doesn't make sense to put a calendar in the calls. I mean, it's out of the money." Won't that lose Vega as the market goes up? Well, yeah, I mean, it might. But
Right.
if Vega's low to begin with, I mean, how much more are you going to lose? I mean, especially if it's at 3-year lows within 3 points of the
It's a great
absolute.
point. It's a great point.
So
And
it
you put this on
helps.
above the market, right, Tony? Initially,
Mm-hmm.
this calendar, it was above the market.
Oh yeah,
So you got deltas working for you while Vega's working against you, and that's another plus of putting it up
yeah,
there.
it's just a balance. It's a
Yeah,
balance
yeah,
so that I mean, because you want to look like this. So the other part of me trading is that I'm sort of visual. So I really, really like to see my graphs
right.
look
Yeah,
correct. Now, sometimes you'll start a trade and you may have done the same trade, 10 times before, and then you start it and your graph like really looks crappy. You're like,
mm-hmm,
wow, why does that look weird? Well,
mm-hmm,
there's usually a reason, and that means you shouldn't start the trade, and it usually has to do with skews,
right,
like between implied volatility of front month, back month, and it depends on the time to expiration. So,
right.
but what I wanted to point out today, quite just simple, is that um, yeah, you can do well with just singular tactics.
Mm-hmm,
Okay, but remember that a butterfly is not a strategy; it's sort of a tactic. Now I know people call it a strategy, and that's okay. So the terms are interchangeable, but your strategy is to benefit from time decay. Uh, so that butterfly worked out pretty well, but there was a lot more adjusting, and to me, I would have been concerned,
right.
a lot more
And
concerned about my position.
there was a lot of risk, more risk in that position too, compared to
Yeah,
this position.
yeah, and there was a lot of contracts that you had to navigate slippage on.
Right. Yeah, and you don't know, in a hypothetical like this, you would show one profit, but when you actually had to move those and wait around and get filled, and the market starts moving, you got to
Mm-hmm.
get it done. It could have been a very, very different P&L.
Right, and your puts get filled, and then your calls don't, and then all of a sudden it's 30 cents lower, and you start going, crap, what do I do? You know, and I'll tell you another thing. A lot of people trade the rut, and I do too. And they get lulled into thinking that they can use the 5 point strikes and they can sell and buy and sell 100 contracts. Well, yeah, but why not gear the thing with lesser contracts to achieve the same amount? I mean, a lot of us, I don't know, it's psychology. We want to like say, look, I got 100 contracts, you know,
Right,
or
right.
something. I've seen people trading 1,000 lots in the rut
uh,
at 5 point strikes, like on a credit spread. And I'm
uh,
like, man, you could do the same thing with 50,
right.
50 lot, because I'll tell you, you lose a dime on 1,000 or even 100, it adds up. It's a thousand
Yes, it does.
dollars,
That's
you know.
right.
So anyway,
All right.
so my
Why don't we take one more question, Tony?
sure.
From Bobby Bavsar, in very high vol, such as 40 plus VIX, can Tony give a quick summary of what his initial setup would be at the start? You going to trade an environment like that?
Yeah,
40
yeah.
plus VIX, we're talking about,
Oh
once
yeah,
every
I've
two,
traded
three
it.
year.
Yeah.
Mm-hmm. Okay.
Okay. Well. Okay. I can't give you like specifics because it would depend on how long the market's been going down. Did it just start? Has it been forever? Blah blah. But I will tell you this: that what I will do is in a volatility situation like that,
Mm-hmm.
um, I will be short Vega,
Right.
okay, but I don't want to be really really short Vega, even though the Vega vol could collapse from 40 to 30 to 20 or whatever. It could also go screaming north. So there's a reason why the vol's that high. So I would have something similar to this,
Mm-hmm.
um, and I would still I, I would have a larger debit spreads in front of my credit spreads. I wouldn't go with a ratio spread because a ratio spread, by definition, is going to leave you sort of naked for quite a period of time. Um, you could get underwater pretty quickly. But anything that would be short vol
Mm-hmm.
is something that I would incorporate. But again, what I'll do is it doesn't matter if volatility is that high or if it's at 20. I don't want my theta to Vega to get more than 3 to 1. So I don't want Vega to be, short 10,000 and have theta, gaining me $1,000 a day.
I see.
That's a directional play.
Right.
I'm okay to go 3-to-1 starting out, but I really like it to be 1-to-1
Mm-hmm. Theta to
because,
Vega.
yeah, theta to Vega, yeah. And then
Right.
I like to keep my delta, you know, eh, starting sometimes it might be 30%, but I like to keep it at, you know, well, as low as I can get it. Under 10 is great. But I can't tell you exactly if I would do like a out of the money put butterfly.
Mm-hmm.
It just depends. But I want to, under all circumstances, I want to keep my Greeks within the same ratios that I've sort of outlined.
All right. Well, Tony, we could go on all night, considering different things, and it would be awesome. The thing is that we like to keep the Options Tribe meetings down to, about an hour, and it's always thought-provoking having you on, and I know everyone wants you to come back. We'll talk about that offline.
I got one
Why don't you
final
go ahead?
thing.
Yes. Yeah,
Yeah, I
please.
was just
Please
going to
do
tell
that.
you. Check out our website now. What we have is, we have an options trading room. Look, this is where I trade 2 accounts live. Okay, one's a Reg T account, one's a PM account. Portfolio margin. Portfolio margin has 125 of capital. The Reg T has 50,000.
Mm-hmm.
3 times a week for an hour, Monday, Wednesday, Friday. We make adjustments, obviously, outside of those hours. I send out text messages and emails before I make the adjustment, not after. We got a little special trial for you guys. If you want to check it out for a month, it's $1. So yeah, so for that big dollar, you can go in and you can see the recordings. All of our sessions are recorded; they're stored in there. We also have pictures of each adjustment as the positions move along every day. You'll see pictures of the matrix. You'll see the graph. You'll see the adjustments. So it's all in there. For you guys to see. It's a great deal. It gives you a chance to go look at it. I'll give you just a quick example. I know you got to go. This is our text messages. Look, this is where they're recorded. These are all the messages and adjustments that I've sent out in real time. Here's the ones from yesterday and today in NDX. Okay, this is what the members area looks like. You can go to the trading room. You can see like the Reg T account. Oh, I have to re-log in. Darn it. Okay, well, anyway, under that tab, you'll see all the pictures of the trades.
Mm-hmm.
When I say pictures, I'm talking about the graph, the matrix, and all that stuff. So check it out. You might find that it's worthwhile.
I'm certain that it will be, and I
That's
encourage
the address
everybody
to
to
go
do
to,
just
by
that.
the way. If you want to sign up for the dollar, for you guys, you got to go to this address right here.
All right, and if anybody
I can't
somehow doesn't have that handy, then I will, just send me an email or send Tony an email, and he can give you the
type it in the
URL for that
chat
as
real
well.
quick. I wonder if can I do that? Because I can't see anybody's chat. I don't know.
Do you have a question? I don't think it'll quite work out that way, but I think everyone can simply see it from looking at the screen, Tony.
Okay. Well, they have to write it down, so.
Yeah, and if anybody doesn't have a pencil handy, just send me or Tony an email, and we'll share with you that URL. Well, thank you, Tony.
I appreciate everybody being here tonight. Yeah, I appreciate everybody being here. Hope that this was worth your time. And again, hey, singular strategies are one thing, combos are another. I just think that people, for me and our subscribers, find that combos are a little bit better in the long run.
Yes, and you could sit and argue that all day, but nobody can argue with the success you've had, and you're consistent. This has been your theme, managing by the Greeks. The structures have changed over the years, but the that basic principle of keeping everything but theta. That's the one you want to get as big as possible. That's a very cool concept. And
right.
Those of you who've followed you over the years know how consistent you've been with that. and we can't talk about returns here on the options tribe, but I don't think anybody would be very unhappy with the position that you put yourself in. So, folks, Tony, first of all, thank you again for your fantastic presentation. Have a wonderful holiday season. Everybody should take advantage of Tony's chat room offer. You can't get cheaper than $1. And we encourage everyone to do that. Anybody who didn't get that URL down, just send me an email, and I'll send it right out to you. Tony, thanks so much.
Yes, sir.
For being on the Options Tribe. You're the
you.
man. Really appreciate all your help, and we'll see you all next week on the Options Tribe. Take care.
Bye-bye.
Okay.
Bye.
Thanks again, Tony. Bye.
Yeah.